Okay. Good afternoon. This is Robert Young, as you know, from Salt Lake Community College. And I want to greet all of my students at Discover Finance 1050. This is obviously not the condition we want to finish the class in, but it's what we need to make do. First of all, my main thought is for your well being, and I would hope that all of you are following strictly the instructions that we receive from governmental authorities and from your employer at Discover. I know, knowing Discover as well as I do, that they obviously have your best interests in mind. So, as we go forward, assuming that this first one works, let me outline some of the way we're going to do this for the balance of the semester so we can finish this class and so that you can get the appropriate credit, which is important, and also the appropriate assignments and understanding. We will do each week, I will do about an hour lecture like I'm doing now on YouTube. And then I will send this lecture to Angela Farnsworth, and she will disseminate it to all of you. And I will also be sending all the handouts to her, and she will email those to you, including a revised schedule. And we will work on kind of the same schedule with some changes that I'll go over, and you'll see. Hopefully by the time you look at this YouTube video, you'll have the new schedule. A couple things that will be eliminated. We will not be able to do the oral presentations, obviously, on the book report and the term paper. I still want you to do the written presentations or the written reports and email those to me. They'll be worth 20 points each. I'm going to try to email to Angela the Susie Orman DVD, and that you can watch that kind of like you do on this at your convenience when it works out for you. And as it says in this outline, you can send me a written report of what you got out of that, and I will give you the credit. In each of these assignments, I will give you an in-class assignment, the 5 points that you're used to. And if you'll email those to me, you'll get credit as you always have done. What we will do is go on a bit of a revised schedule since we're not going to do the oral reports, which hopefully you have by now when you watch this YouTube video. If you don't, let me know. One other thing that has changed, I did tell you a couple weeks ago when we started talking about investments that if you opened up a mutual fund, I would give you 20 points. I think what I've decided that's fairest given the financial challenges and duress that maybe we're all under at this point in time, I'm going to give everyone 20 points. I'm going to send out the link for mutual funds. My fondest hope would be that somewhere down the line, when things normalize a little bit, which hopefully will be sooner rather than later, that you do take advantage of opening a mutual fund. We'll talk more about that in this particular lecture. I have put on this handout, and you should have this already. First of all, my telephone, my cell phone, and as I said from the very beginning of the semester in January that I would not give this out if I didn't want you to call. I have no problem with you calling, texting, or emailing me if you have questions or concerns as we go forward. So again, my hope, and for all of us, is that we live safely and we will get through this. One of the great things that I will say again before we jump into today's lecture on mutual funds is I cannot reiterate enough that you work for a great company in Discover. And as my wife Karen and I have evaluated our family and our children, sons and daughters-in-laws, with the challenges they're having as we go through this coronavirus challenge in our lives. We've been grateful that all of them, myself included, work for very good employers, stable employers, and not everyone is so fortunate. Obviously, Discover is a great place. So my best to you as you go forward, and hopefully we can get this behind us. But the key element here to being successful for the balance of this class is communication. So please communicate with me. I'm happy to visit with you, talk to you about anything that you're doing. This won't be the same as our in-class lectures and our in-class communications, obviously, but we want to make this as good as possible so that you can finish strong and have a good, sure foundation as you go forward. This afternoon, as I said, these lectures now will just go for an hour. I don't think anyone wants to listen to Robert Young for 2 hours straight on YouTube without any interaction. So we'll do this for about an hour, but we are in chapter 13, which are the investing fundamentals. So we're going to take a look. Might be a little bit of a review, which we did 2 weeks ago, last time we met, and before the Solid Community College spring break. I want to talk about the fundamental elements of investing, and in particular talk about mutual funds, which probably the greatest way to give us access to the stock market. As I mentioned to you, and there's probably no greater illustration than the last few weeks with the gyrations and challenges in the investing and financial markets about what I talked about in investing. And as I said, and I hope you remember, that I said there are two real key elements in investing. Number one is it is long term. And I think all of you know, and this might be a good test question on your second exam, the week of May the 5th, long term is the rest of your life. And again, there's nothing wrong with setting up an investment program where you take out some of your gains from time to time, assuming there are some gains, and there will be in the long run, I can assure you of that, and use it for given goals that you may have set up. And the second element that we talked about is diversification. And one thing that this does illustrate with the recent drops in the stock market and all the changes is that there is risk in investing. We talked about the direct relationship between risk and return. And the greater the potential return, the greater the risk. But we've got to be in the stock market and investing for the long haul. There have been a lot of ups and downs in the stock market over the last 125 years that it's been in existence. Actually, the stock market has been in existence, they said, 228 years. You think about, I know that you wouldn't remember these, some of these I don't, but we had the the Depression in the 1930s that our grandparents and great-grandparents were raised in. I was reading in the early 1970s, I vaguely remember this, and what was known as the oil crisis. In 1987, we had a big dip in the stock market. 2008 to 12, we had our most recent recession. So ups and downs are what the stock market is about. But in the long run, over the last 110 years, as we mentioned 2 weeks ago, nothing has had a greater return on investment than the stock market. But again, you got to be in it for the long haul, and you've got to diversify. In other words, spread your money out into a lot of different investments. We would never want to put all our eggs in one basket. Even as successful as some companies have been, you take like Walmart today, even Discover, Cincinnati Financial, where I work, we would not want to have all our investments in one company. The market is too diverse. The world that we live in is so changing, and there's no greater evidence in the changes that we've seen in the world and here in the United States in the last 4 or 5 years. Now, I'm in chapter 13. A little bit of this is review. But one of the things that I think as you start an investment program is definitely to set up some goals. Remember, at the first of the semester, we talked about the 3 different time elements with goals: short term, less than a year; intermediate, 1 to 10 years; and long term, greater than 5 years. When you start to set up your goals and set up your investing goals, I think it is a good thing to just write down some of the long-term things that you're interested in. A good example would be a down payment for a house, a vacation, maybe a second home. All of us are different. There might be a large a great variety of things that we might have a goal set to. Some of the things mentioned on 458 might also be an emergency fund. We know that Dave Ramsey talked extensively about that. So I would say the first thing is to set up your goals, the things that you want, and the things that are important to you, and then work in that particular direction. Again, on 461, it talks about the factors or the elements that affect the choice of our investments. One is the safety and the risk. As we mentioned, there is risk in the stock market. I think we had mentioned that if you want pure safety, there are probably three places where there's no risk. One would be in a bank account that is either insured by the FDIC or the NCUA, going into a bank or a credit union. The second would be U.S. savings bonds. And the third would be what's known as U.S. Treasury bills, T-bills. The challenge there is that, quite frankly, the return on those is very small, generally maybe 1.5% at the most or less. The good element is that they're safe. Right now, if you had all your money in those type instruments, you wouldn't be worried about the downturns in the stock market. But again, we're in it for the long term, and if we are, we should do just fine. It does talk on 461, the risk versus return, and again, we need to realize that in the stock market, there is risk. There is always risk. And the greater the potential return, the greater the risk. I think I've mentioned that on when you watch American Greed or you read about scams, which are very unfortunate, the people that perpetrate these scams are generally people that seem to be pretty sophisticated and knowledgeable about the market. But they always have this common element, and that is they promise great returns for little or no risk. That cannot happen. There's no more chance of that happening, as I've said before, than the sun rising in the west tomorrow. Whenever there's potential returns that are great, there has to be a lot of risk. Now, as it says on 462, as we set up an investment program, we evaluate what's known as our personal tolerance for risk. And it's different. Everybody has different attitudes. They have different backgrounds. It has to do a little bit with our age. It has to do a little bit with maybe the financial position, the family position that we're in. Some people are more risk averse. They don't want to take on as much risk. Other people are much more willing to take on risk. And so we just kind of have to evaluate that so that we can have something that'll fit our personality. Because the last thing we want, and this might be an exaggeration, is quite frankly to lay in bed at night and worry about our investments. We want to, feel comfortable that we've invested good and that in the long term we're going to be in good shape. Now, I think all of us, if we've invested, I think all of you are in at the 401k, and discover there is no question the value of your 401k, just like mine, here at Cincinnati Insurance has gone down quite a bit in the last few weeks. To be honest, am I worried? I'm really not. I'm in it for the long term. I'm older than all of you in the class. It's going to be several years before I need to access or tap in to my 401k. And I have perfect confidence in the world economic system that when we get through this coronavirus and we get this behind us, and it may take a while for confidence to come back in the market, that it will come back. I go back to 2008 to 2012. All of you were much younger. You may not realize that, but the market dropped about 25 to 30%. And a lot of people got really worried. It was mainly because of the housing bubble and maybe being overextended on credit. But the market came back and came back with a vengeance and with a roar. So that is important for you and your partner, your spouse, that as you start to look at an investment program, that you look at your tolerance for risk and the type programs or investments that you put your money into will kind of explain to you how risky they may be. And generally most people in a mutual fund, that's the nice thing with it, they invest it in literally hundreds, if not thousands, of different stocks. There's different type funds. Some are riskier than others. And my only thought is that I have no problem with investing in a risky fund. I certainly have some, and they're a little more risky, but you certainly wouldn't want to put a lot of your investment portfolio or a lot of your eggs into something that's extremely risky. Maybe five, no more than 10%. And then if you get stung and it doesn't work out too good, it might sting a little bit, but it's certainly not going to be anything that will be very detrimental. One of the things it does mention that you can calculate, or you don't really need to do the calculation, but as you invest in given accounts, it's always good to take a look at the rate of return, and especially how a given mutual fund or a given investment has performed over the last at least 5 years. That's what's basically known as trend analysis, where you can take a look at the trend and see exactly the direction that it has gone. And a lot of times it's good to compare it to what the general stock market has done, the Dow Jones Industrial or the NASDAQ, some of the other indexes that we've talked about. Some of the risks that are talked about, general risks that as we invest, start on 464. Inflation risk. Inflation has been tame, quite frankly, for many, many years in our economy. It's generally been between 2 and 4%. I can remember when I was a teenager, quite a few years ago, sometimes it get around 15%, 12 to 15. It was much more of a concern there. Interest rate risk. Interest rates are about as low as they've gone. You may have noticed that the Federal Reserve, Jerome Powell, who is the chairperson of the Federal Reserve that we've talked about, lowered the prime interest rate to 0 to help give the economy a little bit of trouble, during this coronavirus difficulty. Interest rates are set, as we said, the prime by the Federal Reserve, and interest rate generally have been low, and coming out of this difficult situation that we're in, I would be very surprised if the interest rates go up very much. Business failure risk on 465 is a real concern right now. There obviously are going to be several businesses that are going to be very, very challenged. We know in particular the airlines are right now, as very few people are flying. The airlines have asked for a huge bailout from the federal government. We'll see what direction that Congress and our government goes with that. That's a good example of why we want to diversify. A few months ago, when the economy was booming, people were flying all over the world. The airlines were doing very well. Literally now, they're grounded and struggling financially. Market risk, or just the general markets that we're in. Again, we're in a tough market now, as we mentioned. One is the global, and another one is the global investment market on 465. And needless to say, we live in a global economy, in a global world, and there's not. It just is the way it is. I know that some people are want to have protective tariffs and things like that. We've talked about that earlier this semester. In spite of that, we are in a global economy, and what happens in other countries affects us directly. There can be no better example of that than the effect of this coronavirus right now. One of the nice things that we do invest, and when we buy stocks or when we buy into a mutual fund that we'll talk more about in a few minutes, is liquidity. Liquidity is the opportunity to get our money quickly. Generally, if you have stocks or if you have money in a mutual fund, you can usually get the money within 72 hours, which is three business days. So it's very liquid. Unlike if you invest in real estate, if you're trying to sell some real estate, you're probably lucky to have your money in 90 to 100 days by the time you list a property, get it sold, and go through everything that takes. So that's one of the advantages of the stock market, is liquidity. Now, I want to talk, and one of the things that is brought, that talks about is your asset allocation, starting on 467. Again, this is diversification. I think it goes without saying, and we know that we don't want to put all our eggs in one basket. Ample evidence of that uh, today with the challenges that we have. Some of the elements that come in, though, when we choose is on 469, and that is the time factor. And the time factor is basically how long you want to leave the investment in. Obviously, for me, I'm older than the rest of you. My time factor would be a little bit different than those of you that are in your 20s or 30s or 40s. The time factor, though, can change a little bit, especially if you have a particular goal, like a down payment on a home, a trip to Disneyland, something like that. So you might have, and you don't have to take all your investments out at one time for when you reach these goals, but you might have a couple that will be seasoned or pointed in that goal. Your age, I already mentioned that, certainly comes into being. Other things would be your financial position when you may or may not want to retire, other things that you may want to be doing. There are many alternatives when you invest. Um, one is just to go into the stock market, and one of the things that you should have in a handout or that you will get that I'll be sending to Angela, and that is really interesting. It's an inspiring article. I wish we were together, but I'm going to go over this. And the name of this article is How Ann Scheiber Made $22 million from Her Apartment. I hope you take time to read this. Let me just give you an overview. Ann Scheiber is long since passed away. She was kind of a recluse, a single woman in New York City who never married. And she had, I think, just a high school education, maybe a little bit of college. And during the Depression, this would be back in the 1930s, she started to work as an examiner for the IRS, the Internal Revenue Service. Okay? So what she did was she examined tax returns. Well, Anne, unlike most of us, and I'd probably be in this category, just humdrum job and go through the tax returns, make sure the numbers added up and everything was correct. But she noticed a common element. The people that were the wealthiest, that had the most money, there was one commonality among all of them, and that is they invested in the stock market. And when she retired, and when she passed away in 1995, and I think she was just about 100 years old, she had a wealth of $22 million. And she never had a high paying job. As I said, she lived in an apartment in Manhattan, never married or anything like that. She was kind of a recluse. She was actually kind of a notorious tightwad. They said that even though she had all this money, when she wanted to read the Wall Street Journal, she would go to the public library there in New York City because she didn't want to pay for a subscription to it. But Anne noticed in the mid 40s, she retired from the IRS, says she had a $5,000 lump sum of capital that she saved. She also had a pension of approximately $3,150 a year. So as you can see, she wouldn't say that Anne uh, um, was swimming in money. So she just decided that she would do what all these wealthy people had done over the years, and she started to invest. She at first invested in some of the big stocks like General Electric, Coca-Cola, General Motors, some of the big companies at that time. And she was definitely in it for the long term. It was interesting when she passed away and donated this $22 million to Yeshiva University. It's a small Jewish university in New York City. She had not gone to college there. They never heard of her. And so what a great surprise for them one day to get a $22 million gift. But she stuck to the big companies that paid basically good dividends. And as I said, the Coca-Cola, General Electrics, General Motors, probably Walmart's, companies like that. And so it was really interesting that she accumulated this money basically through investing in the stock market. Now, notice the elements that we talked about apply to Ann Scheiber. Number one, she was in it for the long term. She started in the 30s and 40s and actually never liquidated. This was part of her estate in 1995. And number two, she diversified. She did not put all her eggs in one basket. She stuck, though, to the big companies that had good track records. She did a lot of research on it. Now, I'm not saying any of us would want to live a life like Ann Scheiber and be a recluse and never spend any of our money. I don't think any of us want to die multi-millionaires and recluses. But we can learn from what Ann Scheiber did. And she had discipline. She studied it out. And she was in it for the long haul. And so she embodies all those things. Now, the question is often given, and I want to talk about this extensively. We mentioned this 2 weeks ago, and that is mutual funds. Because you might remember the exercise that we did at the beginning of class 2 weeks ago. And one of the two we did was I said, how much could each of you afford to invest each month? Every one of you had an amount you could. I think the lowest in the class was like $50, some $300-400. Now that might change a little with some of the changes in the stock market. But I've come to this conclusion, both myself as an investor and teaching this class for many years at Salt Lake Community College and the last 3 at Discover. The reason people don't invest is because they don't know how to. It's not because they don't have money. All of us have enough money. Even with this coronavirus, I'll bet every one of us, especially all of you working at a place like Discover, place that's going to weather all the storms and is well-founded, know what they're doing, we have money to do it. But here is your assignment for today, okay? So again, on these 5-point assignments that we've had each class, now you'll need to email them to me. And if you'll email this to me, you'll get your 5 points credit. And if I'm doing it correctly, which sometimes I do, and every now and then you have to correct me and make sure I do, it will be in Canvas. Canvas is still up and running. But I want you to write down at the end of this presentation or sometime and email it to me for 5 points. And just let's think about it. Why would you not invest? Is there a reason you really wouldn't invest? And write that down. And then we're going to take a look at those. And next week, at the beginning of class, at the beginning of the presentation on YouTube, I'm going to address some of the reasons that we might not invest. So just be honest on it, write it down, send it to me. So number one, most important, you get your 5 points credit. But number two, we can talk about some of the reasons that maybe we wouldn't invest. Now, I'm going to tell you an interesting personal story. As you know, I've told you a lot of stories about Karen and I and our family, maybe more than I should have, but I think we could just examples of things that have worked for me. But let me tell you how I got into the stock market. I can still remember, I don't remember the dates real well, but this was when I was working at my first job, and this had been in the early 80s. Karen and I had been married for a couple of years, 2, 3, 4 years, and our oldest son had arrived, so we had one child. And one day I was in downtown Salt Lake City, and I happened, of all things, to run into a friend of mine that I'd known back in Charlotte, North Carolina, where I think I've told you I grew up, spent my adolescent years. And we had a fun visit on the street there in downtown Salt Lake City and talked about a few things, caught up on friends, family, neighbors, and common acquaintances. And then I didn't even know what he was doing. He told me that he was a stockbroker for a brokerage company. And he asked me a question. He said, Robert, are you investing in the stock market? And Karen and I had just bought a home, like I say, had a little baby. And my response was probably typical. And I said, no, I don't have enough money. And I'll be forever grateful that Jerry Higginson wouldn't take no for an answer. And he said, Robert, you do have enough money. He said, I would like you and your wife, Karen, to come down. I'm going to buy you lunch at one of the restaurants here in Salt Lake City. And we're going to talk about setting up an investment program. And I I thought it was fruitless, but knowing me, I got the opportunity to have a free lunch with a friend, so I thought, why not? So a couple weeks later, we made arrangements for a babysitter with my son, and Karen and I came downtown and had lunch with Jerry. And he outlined and made me realize, because quite frankly, at that time, I thought, like maybe a lot of you think, investing is just, it takes a lot of money. Even back in the 80s, I would have thought it probably took $10,000 to start investing in the stock market, which I didn't have. But Jerry said, introduced me to mutual funds. I'll be honest with you, mutual funds weren't as popular back then as they are now. I don't know that I even knew what a mutual fund was. And he kind of had to go into kind of elementary investing for Robert Young and explain to me what a mutual fund was and told me that I could do it for 10, 20, maybe $30 a month. And I was a little reluctant, but I said, we need to do it. And Karen and I talked about it, and we opened up a mutual fund, and I can't remember what we put in a month. I want to say it was $15 to $20 a month. And as I look back, and I'll say the same thing for all of you as you open up a mutual fund, which I hope you soon do, in spite of the market conditions now. The act of opening up the mutual fund and starting to invest was more important than the $20 or $30 a month I put into it. Because once I started to invest, and once I started getting, I guess, the quarterly or monthly statements from the stock brokerage firm that he worked for, and I started seeing the returns, which were very good. I mean, they weren't spectacular, but certainly better than what we were getting in a savings account at any given bank at that time. I started to get excited about investing. And Karen and I have been investing ever since. And it's the best thing that we have ever done financially is to invest. I can't emphasize it enough that if you'll open a mutual fund and start doing this, it will be great. Now, the best way to do this is to get a fund where they just take it out of your checking account or your bank account. Checks are kind of becoming obsolete, but take it out of your bank account once a month. Unfortunately, they don't have it as a payroll deduction like your 401k. If they did that, that'd be even better. Maybe that day will come. But get it where they take it out of your bank account. That's what we have. On the 20th of each month, X amount is taken out of my account. And guess what? If I know that X amount of dollars is going to be withdrawn from my account once a month, the money's there. It will be there. Because I do remember when we started in the 80s, I didn't have the automatic withdrawal. We had to actually write a check out once a month and send it in. And that's a little bit harder. It's just so easy to spend the money. But, excuse me, if you'll set that up on a Check-O-Matic, it will work good. Now, the question is which mutual fund? And let me just say, and I want to say this very, very clearly from the very start. And I think hopefully you know that enough about me, that I do not work for an investment company. I do not make any money off of your investments. I get paid to teach this class, as I said, and that is plenty, and that's nothing more, nothing less. I want you to invest because I know in the long run, in spite of the difficulties we're in today, March 23rd, 2020, I promise you, you will never regret it. So one of the handouts you have says mutual funds, and I've got 1, 2, 3, 4, 5. I have 6 different mutual funds that are all good and solid, and I've got their name and their website. You can go into any of these, and you can set up a fund. And generally, it might take $50 to open it, and then you can start to put in as much or as little a month as you want. The nice thing is that you can change it from time to time. If you're not happy with any of these 5 mutual funds that I have down, you can Google mutual funds, and believe me, you'll have, you know how the internet is, the first page you'll have 1 of 6 of 6 million choices. So there are tons of mutual funds. So I would encourage you and beg you for all I'm worth, in spite of the difficulties we're in now, to open up a mutual fund. Now, this is over and above your 401k. We've talked a little bit about it when we get into retirement planning in a couple weeks. We'll talk more about it. Your 401k is to supplement your retirement. I think we've talked enough about it, and I think everyone in this class is in the Discover 401k. Hopefully that's the case. This is over and above your 401k. This is investing for, again, some of the things you may want: a down payment on a home, a vacation, a second home, a special trip, whatever it may be. Finish your basement, do an addition to your home. This is a personal investment over and above. And as I said, originally I would give you 20 points. I've already had a couple students who have emailed me if you'll open up a mutual fund. Well, now I'm going to give everyone that 20 points. I don't want to put any pressure on you if you're under some financial duress, maybe if a spouse has lost a job or had hours cut back at your work during these difficult times. But we're looking at this in the long haul. So I am still, in spite of the downturn in the market today, I am as bullish today as I've ever been on investing in the stock market. I have great faith in our country, in who we are as a people. We'll make adjustments. We'll get through this. I was watching the other day on the Discovery Channel. There was the Spanish influenza, I think in 1918, 102 years ago. We hardly know about it. It was even more difficult. Who knows where this will end up than what we're going through now. We got through that. We got through the Great Depression, 2 world wars, wars in Vietnam, the oil embargo. We've gotten through a lot of challenges in our country. We will get through this. So I would encourage you to invest. Now, a mutual fund, when you put money into a mutual fund, they have a whole bunch of different investments, a little bit like your 401k. In fact, I'm sure that your 401k at Discover invests in different mutual funds. And in a mutual fund, the advantage of the mutual fund is you get automatic diversification because they're investing your money into literally hundreds, if not thousands, of different companies. And they should send you a prospectus or a booklet that you can take a look at or look at online, and they'll tell you the different companies that they're investing in. In fact, maybe I can get a list of a prospectus, an idea, and I will try to get that to Angela so that you'll just have an idea of the great diversity that you get in a mutual fund. The second advantage is that they have professional management. Now, most of us don't really have time to manage our accounts. We're busy enough taking care of our employment at Discover or Cincinnati Insurance, our families, maybe coping now with the coronavirus, all the above. One thing you'll notice on the Ann Schreiber when you read her story is that being, single, no family, a recluse, if you will, she really studied the stock market. I consider myself, an investor, obviously, but I don't have time to study the individual stocks. The nice thing with a mutual fund is you have a professional manager. So I am bullish on mutual funds. So I will send you that. Hopefully you can open one up. But really, I do not want to put anyone under duress, and things have changed in the last 3-4 weeks. But I hope in the long term, as I've said many times, if I were to run into any of you in the next, say, 3 years from today, of all this behind us, and we can talk a little bit about it, I would be thrilled if you could tell me, number one, you're still budgeting, and number two, you have invested in the stock market through a mutual fund. I can promise you, no matter how difficult things get, and no matter what types of ups and downs may come in the next 40 years, this will just be one of many bumps in the road that we all endure through our lifetimes. You'll do just fine if you do those two things. So I'm a great believer in mutual funds, and not all mutual funds are created equal. I've given you several to take a look at. When you look at them, you can look, maybe even call an advisor, decide what level of risk you want, some of the goals that you're having as you pick different funds to invest your money. Um, there are many varieties. One thing you want to take a look at is their return over the last 5 years. And also, they do have expense ratios because obviously the people that run the mutual fund, they have to be paid. Some of the other things that are mentioned in the book that we'll talk about in investing, that you may have thought of, one is real estate. Some of you may have invested in real estate. I'm not anti-real estate at all, but I do think one thing to remember, real estate is not liquid. We talked about that earlier. A mutual fund, stocks, you can get your money out in 72 business hours. Real estate, obviously, it takes a little bit of time to sell properties, but real estate over the long haul has done good. Hasn't done over the last 100 years quite as good as mutual funds or the stock market, but I think all of us would agree over time, obviously, real estate will continue to go up. My thought on real estate, a couple ways of looking at it. If you're going to own something, I think it is best, if possible, that you be kind of have the time and have the skills to be kind of a handy person to make the repairs. Because if you're always calling someone to fix items in the house or the apartment or duplex, that can be very expensive. So people who seem to do best in real estate seem to kind of have a passion for property. They seem to know how to, for the most part, take care of some of the minor repairs themselves, thus saving them quite a bit of money. And usually it seems to work out better, I think, when the person lives close to the property, so they can kind of keep an eye on it. There's always a challenge sometimes getting people to pay the rent and people not taking care of the property. I think you know exactly what I'm talking about. So, a lot just depends in our particular personalities as we look at various investments. The book talks a little bit about, how you can read certain things, corporate reports, business periodicals. That goes hand in hand a little bit. I asked each of you, I think probably half, maybe a little bit more, have turned in your 3 articles. You still have till the end of the semester, May the 5th, to do that. There are some investor services and newsletters that's mentioned on 478, Value Line, other such things. To get Value Line, quite frankly, you have to go to the public library. It costs a lot of money to subscribe to it. It certainly wouldn't be worth it for anyone to do it individually, but you can go to the library. I've done it from time to time, but they're very detailed type reports. So I hope all of you have gotten excited about that. Now, I want to talk about an assignment that you'll be getting, and hopefully you have maybe by the time you get this. And this is an investment assignment. You'll have 3 handouts on this. The first handout is the kind of what tells you what the assignment is. I'm just going to read this to you. You are to pick 10 stocks and invest an imaginary $10,000, which would be a total of $100,000, 10 times 10,000, for 5 weeks. You will need to track these stocks weekly, and then I have provided on the second sheet a list of stocks. A lot of people don't know which stocks to pick. I have the 30 stocks that comprise the Dow Jones Industrial Average. I have 20 stocks that are listed in the Dow Jones Transportation and 15 in the utilities. These are big companies that you'll all recognize: Alcoa, Bank of America, Boeing, Coca-Cola, Disney, General Electric, 3M, McDonald's, Walmart, Continental Airlines, United Parcel. Some you may not have heard of, but I want you to pick 10 stocks. An ideal one, quite frankly, would be to pick Discover and just follow that particular stock. Okay? So you pick 10 stocks, and then you have, I'm kind of holding this up, and hopefully you can take a look at it. It's called a stock transaction record form. And so what I want you to do is put down the date purchased, and let's say that we're doing it today, March the 23rd, and then you put the name of the stock, okay? And let's say it's Disney, okay? Now, if you go over to the third one is the number of shares. We'll get to that in a second. The fourth line over is the price per share. Well, we're going to need to go online and see what Disney's trading for, because we're going to invest our total cost of $10,000. Let's just say that Disney is trading at $72 a share. Okay? That means, and we'll round this, that we're buying 139 shares of Disney, because if we take $139 times 72 shares, that will give us approximately $10,000. Then you'll notice you